Finally, for the first time in more than 4 years, on September 18th, the Federal Reserve cut interest rates. While the debate over how big the cut would be was settled at a half point and not a quarter, questions about where the Fed will go from here and what it will mean for the economy and markets will continue. The Fed matters, but let's consider the possibility it's been getting a little too much attention. Since the Fed's announcement, the 10-year Treasury yield has risen, not fallen. This move reflects the fact that the bond market had already priced in an aggressive rate-cutting cycle, one that may take the Fed's target funds rate from its current 5% down to 3% by the end of 2025. Unless a recession drags rates lower, which we don't expect anytime soon, the boost to the economy from lower borrowing costs on mortgages and auto loans may be mostly behind us. Stocks also factored in the rate cuts in advance. During this latest Fed rate pause, which we measure from the last hike in July of 2023 until September of 2024, the S&P 500 gained 24%. That marked the best stock market performance during a Fed pause in at least 50 years, covering 9 rate-cutting cycles. But now that the rate cuts have begun, history tells us that more modest returns may be in store. On average, during the year after initial rate cuts, stocks produced only mid-single-digit returns. As always, the economy is the key to better potential returns. When the first year of a rate-cutting cycle is accompanied with a growing economy, stocks tend to generate above-average gains. The S&P 500 gained 14% on average during those 12-month periods. If a soft landing is achieved, which looks more likely than not, further gains for stocks could lie ahead. But even if the recession risk is low, policy risk is high with the November elections just a month away. The uncertainty around policy outcomes has historically caused market volatility in the weeks leading up to elections. Stocks did just fine this September, gaining 2% during the historically weak month. That steady rise suggests that markets are more focused on the still growing economy, falling inflation, and rising corporate profits. However, with several $1 trillion of expiring tax cuts to be negotiated next year, unsustainable deficit spending as far as the eye can see, and tense trade relations with China, don't be surprised if market volatility picks up, regardless of what happens on November 5th. So although we expect that the bull market will likely continue as the economy expands, we know a pullback is likely overdue. Job growth is slowing, and the cumulative effects of inflation have taken a toll. Stocks currently reflect a lot of good news, but the policy and geopolitical backdrops will remain very challenging.